Good morning, my awesome accounting students. Welcome to Accounting 102. I'm so happy to have you in my class, and I look forward to starting this journey of learning about managerial accounting. To get us started, make sure you are in the modules link of your Accounting 102 class. And the way the class will be structured is that I will be utilizing the items in the modules link. We will start off by taking a look at the agenda. We will take turns lecturing with PowerPoints as well as working through as many problems in the textbook as we possibly can. Make sure that the schedule of activities is at the very front of your notebook. It details out what we'll be covering on each class day. Although this class might be in an online environment, I look forward to seeing many of you during my office hours or working alongside you to make sure that any questions that you have are answered. Let's get started. Here's our agenda. Today we'll cover financial and managerial accounting. We'll compare and contrast them. You'll notice that there is a separate handout for this in the modules link. I would encourage you to take a look at it. I know there are a few questions on the exam related to this, but I'm going to spend our class time going through some of the harder concepts to understand. So today is a pyramid building chapter. We're going to be talking about managerial cost concepts, and we're going to learn how to classify costs in several ways. This chapter is considered foundational because if we don't have a solid understanding of how to classify the various types of costs, then we will make errors when preparing financial statements. So today we're going to focus on classifying costs by type. That means that we will discuss the vast difference between a product cost and a period cost. We'll find out how to define each one, and then we'll practice using several examples in the books by actually classifying them. If you struggle with this will affect financial statements and will also affect projections that we'll be making later on in the course material. The book touches upon the difference between variable and fixed costs. We'll discuss how to classify costs by behavior. This is emphasized in another chapter in your book, so I would consider in this chapter that would be light coverage. We'll talk about how to classify costs by traceability, whether a cost is direct versus indirect. This will also become a very important skill set for you to develop. Later on in another chapter, we'll cover classifying costs by relevance, whether the cost is relevant to the decision to be made or not. We'll also learn the difference between a prime cost and a conversion cost. And then the most challenging part of this chapter that we'll focus on toward the end of today and also in day 2 is the ability to track costs from their birth until their death. I'm going to focus on a T account approach because I know what's around the corner. If you can learn to tell a story through a picture like a T account, then the accounting when it comes to doing real life financial statements and schedules will be much easier for you. And then the biggest challenge today, along with using those T accounts, will be computing the cost of goods manufactured. This is a critical schedule that supports the income statement, and the emphasis on the test will be on your ability to both classify costs and then compute the various missing T accounts, as well as compute this major line item called cost of goods manufactured. The PowerPoint slides that we'll be looking at today are all available in the modules link. I'm only selecting certain slides to go over the cost accounting principles that we'll be talking about, and we'll supplement this, of course, with working through the exercises and problems in this class. For those of you that haven't had me before, I believe in hands-on teaching. That means that I believe it's critically important to practice the material. I use an analogy that an old office mate used to share with me. He was a piano player, and he used the analogy that you can't get good at playing the piano simply by watching somebody else do it. And that's true in accounting. What you need to do is get your hands dirty. You need to dig into those problems and work them out. So I will be working out most of the problems in class with you. Then to determine whether you've mastered the material, you'll go home and do very similar exercises and problems on your own. And if you are still challenged by doing that, that means that you need to practice some more. So once again, you're not going to get good at accounting by watching me do it. You need to jump in and get your hands dirty. And I would encourage you to download the Excel files, which are also in the modules link, and work through the problems with me. Okay, let's get started. I'll let you learn about the learning objectives by reading them. These are available both in the text or in the ebook, as well as in the PowerPoint slides. As a check before your first exam, you should go through those lists of objectives and make sure that you're comfortable with each one. Managerial accounting is about providing both financial and non-financial information to an organization's managers. This is very different from the Accounting 101 class that you came from. Managerial account both looks backwards, as GAAP and financial accounting do, but there's also a bigger tendency to look forward. It's about providing the information that management needs to direct, control, and plan their operations, not necessarily in that order. Okay, so some purposes of managerial accounting are listed on the screen. I'll let you read those to yourself. The nature of managerial accounting is very different from financial accounting. This screen is a good screenshot of why they're different. Again, I'll let you read through those because I want to get to the harder part of the chapter. Fraud and ethics are both very important to understand. Your author does a pretty good job of sprinkling these several topics throughout. Make sure that you read about those, but again, my focus is going to be on the classifying costs today and then working through the exercises and problems. Career paths you can also read about. Direct versus indirect. This is a key slide. This is one of the ways that we will be classifying costs. So a direct cost is a cost that you can specifically trace going into a cost object. Usually a cost object will be the product that you are manufacturing. Indirect costs, on the other hand, cannot be directly traced to a cost object. You can read the slide. I think this will become very apparent in one of the exercises that we'll be working on today. Once you've determined that something is a product cost, okay, and that means a product cost is a cost that is incurred in the manufacturing operations, then you'll further be asked to specify which of the three different types of product cost this specific cost is. So first thing I want you to get in your head, there is a difference between direct and indirect costs. We just saw that. Now there's a difference in cost types. There is a product cost, which is a cost incurred in the manufacturing of a product, and there's the opposite of that, which is a period cost. Period costs are non-manufacturing costs. Period costs, unlike product costs, go directly to the income statement. Product costs, as you're going to see today, go through balance sheet accounts before winding up on the income statement. So direct materials is one of the three major types of product costs. And as you see on the screen, direct materials are costs for direct materials that can be effectively traced through the manufacturing process to finished goods. They give you examples in manufacturing or making a bike. Those would be the materials that you can see go actually onto the bike: the tires, the seats, the frames, the metal, brakes, and cables. Whoops, I skipped one there. Direct labor. I want you to think of this as touch labor or dirty hand labor. If a laborer is on the lines, on the manufacturing assembly line, getting his or her hands dirty, creating the goods, that is considered a direct labor cost. You can actually see them working on the line creating the product. And again, an example of that would be a bike manufacturer, any type of product where you have assembly line workers doing the manufacturing. Factory overhead is the third type of product cost. So kind of back up, we've learned about product costs. We learned that product costs are costs of manufacturing a product, and we learned that product costs go through the balance sheet, and if something is a product cost, it can be classified into one of three categories. We saw direct materials. Okay, the key word there is direct. You can directly watch the materials going into the finished good. Direct labor was the second type of product cost. That was that dirty hands or touch labor. You actually watch the assembly line workers creating the product. And then the third type of product cost is what I call a catch-all category. By very definition, factory overhead is indirect manufacturing costs. What does that mean? It's all the other product costs that go into the cost of making a product, except for direct materials and direct labor. So if you know something is a product cost because it is involved in the manufacturing environment, and you know it's not direct materials and you know it's not direct labor, by default it's going to be classified as factory overhead. And the author gives you some examples. You'll notice in all three of those examples, those are indirect. Things like indirect labor, indirect material, indirect other costs. In a nutshell, it's any factory costs, anything related to the factory or the manufacturing process that's not direct materials and it's not direct labor. Another way of classifying costs is by calling something either a prime cost or a conversion cost. This will become very important in chapter 16. Okay, a prime cost is the combination of materials and labor. Those are the primary direct costs that go into creating a product. On the other hand, conversion costs are the combination of labor and overhead. Another way of thinking about that, it's what it takes to convert the direct materials into a finished product. What does it take? It takes labor and overhead. So the two of those costs together are called conversion costs. That's going to become a key ingredient of chapter 16. So once again, I think the author is kind of questionable in the order that he placed these slides in. This is a great summary slide. Manufacturing costs are those costs related to anything that is produced in the factory. If something is a manufacturing cost, it's going to go on the balance sheet. You'll see how later when we work through the exercises. There are 3 types of manufacturing costs. This is a critical concept that you get out of this chapter. The 3 costs are direct materials, direct labor, and factory overhead. On the other side of the house are period costs. Period costs are not related to the factory. Your author calls it non-production costs, that instead of being linked to a product is linked to a time period. Unlike product costs, which run through the balance sheet, period costs go directly to the income statement. They have no future value. They're not being built into the product like the manufacturing costs or the product costs were. They're going to go directly to the income statement. And there's 2 major categories for period costs. The 2 major categories is either it's a selling expense or it's a general and administrative expense, what we sometimes refer to as G&A. So I would consider tagging that slide, even possibly printing it out. It's a pretty good summary of how to classify costs by type. So again, product versus period costs. This might be a little difficult for you to see on the screen. Remember that they're in the modules links. You can go look at them at any time. Product costs are those manufacturing costs involved in creating the product. They are anything related to the production of the goods or to the factory. Product costs have future value. That's why they are capitalized or placed on the balance sheet. You'll see in our exercises later today, we'll actually watch the costs go through the balance sheet. Period costs, however, are non-production type costs, and the 2 categories for the period cost are selling and G&A. So in your notes, write down that one major goal of this chapter was the ability to properly classify costs by type. When we classify costs by type, it's either a product cost or a period cost. If it's a product cost, you need to be able to more specifically break it down into one of 3 categories: direct materials, direct labor, or factory overhead. Or it is a non-manufacturing cost, which we call a period cost, that goes directly to the income statement. Those 2 categories are selling and G&A. Again, another key slide. Okay, so let's jump in and get our hands dirty. Our first exercise is on the screen, and what we're asked to do here are to classify the product costs for the production of soccer balls. So soccer balls is what we would consider the cost object. So I want you to visualize a soccer ball in your brain. And this first exercise is going to have us classify each product cost, because the author has told us that these are product costs, as either direct or indirect. Okay, so again, think about that soccer ball. If you can directly see the item going into the soccer ball, that would be classified as direct. Any of these production costs that you cannot see directly going into that soccer ball would be considered an indirect cost. So that's what we're asked to do. Number 1, leather covers for the soccer ball. That is a direct cost. You can directly see the leather become part of that soccer ball. Number 2, the annual flat fee paid for factory security. Okay, anything related to the factory is a product cost, but you can't see the security going directly into the soccer ball, so that would be an indirect cost of the soccer ball. Okay, coolants for the machinery. You know the machinery is in the factory, and you know that the coolants and the machinery are needed to create the soccer balls, but you cannot physically see the coolants for the machinery going into the soccer balls. That would be an indirect cost. Number 4, the wages of the product assembly workers. Okay, remember in the lecture we talked about touch labor or dirty hands labor. If a worker is on the assembly line getting his or her hands dirty, that is considered direct labor. That would be a direct cost of the soccer balls. The factory supervisor salary. Typically a supervisor is doing just that, walking throughout the factory, making sure that everything is in order. They are typically not on the line. So because that factory supervisor's wages are not considered touch labor or dirty hands labor, that would be an indirect cost of the soccer ball. Number 6, the taxes on the factory. That would be an indirect cost. You know that the property taxes are necessary to create the balls, but you cannot physically see those taxes going into the balls. They are indirect. Same thing with the factory depreciation. That is an indirect cost. You can't see, you know the machinery is needed, you know it's being depreciated, and that is a proper accounting cost, but you can't physically trace the depreciation into the soccer ball. That would be indirect. The rubber bladder interior, that's what we call the core of the balls. That would be a direct cost. You can physically watch those materials go into creating that soccer ball. Okay, the ink for labeling the soccer ball. You can actually watch the ink going in to create that soccer ball. That would be considered a direct cost. And the factory building rent. Okay, you know that it is a factory cost, so by definition, it would be considered a product cost. In fact, your author told us that all of these were product costs. But as far as classifying it by traceability, that is an indirect cost. You can't see the factory rent going into the soccer balls. So take a look at those, go through them carefully, try them on your homework, and of course, if you have any questions, reach out to our embedded tutor or reach out to me. All right, next, exercise 14-5. This is going to have us classify iPhone costs as one of several categories. Now, if I was the author, I would have written the directions a little bit differently. The first thing I would ask myself is, once you take a look at the iPhone type costs, ask yourself, is this product cost, meaning is it related to the production, or is it period costs, not related to the production? Once something is classified as a product cost, you have to further break it down into one of 3 categories, either direct materials, direct labor, or factory overhead. On the flip side, if something is a non-manufacturing cost or a period cost, we would break that down into either selling or general and administrative. Okay, so first one, the display screen of an Apple iPhone. That is a product cost because it is involved in the manufacturing, and that is a direct material. You can see those display screens become part of the Apple iPhone. The assembly line supervisor salary. We know that that is a product cost because the assembly line is inside the factory. And we know that supervisor salaries are not direct line. They're not on the lines getting their hands dirty, so it would not be direct labor. So we're going to use that catch-all category of factory overhead. Number 3, the wages for the assembly line workers. Okay, we know that's a product cost, so we're left now with materials, labor, and overhead. And we know that direct assembly line workers have what we call touch labor. Their hands are actually on the iPhones, getting their hands dirty. That is the definition of direct labor. Okay, the salary of the CEO. Okay, the CEO of Apple is not sitting in the factory. That is not considered a product cost. That leaves us with period costs. The CEO is not directly related to the sales process. His or her salary would be considered general and administrative, or G&A. Let me scroll down. Number 5, the glue to hold the iPhones together. Okay, glue is an interesting category. It is true that you could directly trace the glue into the iPhones, so we would tend to be led to call that a direct material. But if you have a cost that is so insignificant that it's not worth tracing or tracking the cost to the various lots of iPhone, we are actually going to call that a factory overhead. Okay, glue, in case you haven't been into a factory, is very inexpensive. It's bought in these huge barrels or containers. They're not going to track every little cup of glue that goes out to the various lots. So because of that, it is a product cost, but a company's more likely to call that a factory overhead because of the insignificance of the cost and the hassle of tracing it to each iPhone. So I'm going to call that factory overhead. The uniforms for the factory workers. If somebody's in the factory, that is considered a production cost. So now we're left with these 3 choices. Uniforms are not material. The uniforms are not direct labor, touch labor. By default, then, they go in that catch-all category called factory overhead. Okay, wages for the retail, that's a key word. If you see the word retail, that is a selling expense. The retail workers are not in the factory. They're in a retail store selling the iPhones. That is an example of a selling expense. And then the last one, depreciation. Depreciation of any kind is considered a factory overhead cost. So take a look at those. Again, work through these problems in your homework. Reach out if you have any questions. Let's go take a look at one more before we go back to our lecture. I believe that this is an example of a possible test question. It's a great summary of what we covered in the first half of the lecture today. So I think I'll use my electronic pencil and see if I can fill this in for you. It says a car manufacturer, so the cost object would be a car, incurs the following costs. Classify each cost as either a product or period cost. Okay, so once again, go back through the definition. A product cost is something related to the production of the cars. They take place in the factory. If it is a product cost, he wants you to further classify it as direct materials, direct labor, or factory overhead. On the flip side, if it is a period cost and it has no future value and those costs do not take place in the factory environment, then it's considered a period cost. Remember, those period costs are expensed immediately, and the author further would like you to classify those period costs into either a selling expense, which means it is related to the retail side of the organization, or a G&A for all other types of period costs. Okay, I'm going to hone in on key words. Factory electricity. The word factory tells you that it is a product cost, and because electricity is not a direct material and not direct labor, it would be considered a factory overhead cost. I'm using check marks instead of X's because it's easier to not lift my pencil. So I know the directions ask you to place an X in it. I'm using a check mark for ease of understanding for me. Okay, advertising. Why do we advertise at all? To create sales. So that is a selling expense. Depreciation on the factory machine. Okay, once again, a factory cost is a product cost by definition. So depreciation is a factory overhead. It goes into that catch-all account. Batteries for electric cars. Okay, the batteries are a key component of an electric car. That would be considered a direct material. You could physically watch the batteries being placed in the electric cars. The next one, office supplies used. If you see the word office, that means that it is a period cost. It's not a selling expense. That would be a general and administrative. So in the first half of these different types of costs, you'll see me honing in on key words. I would encourage you to do the same thing. Okay, wages to assembly workers. Those workers are what we call touch laborers. That would be considered direct labor. A salesperson commission. Commission is a key word. The reason we pay commissions is to generate sales. That would be a selling expense. Okay, steel for the cars. Remember the cost object of this, we were making cars. Steel is a direct material. You could actually see it going in. Depreciation, this time on office equipment. Office is considered G&A costs. And lastly, the leather for the car seats. Again, you're manufacturing cars, so we know it's a product cost. When we're forced to categorize it further into one of the three categories, the leather for the car seats would be a direct material, something you could see directly going into the product. Okay, you may want to pause for a little break because the second half of today's lecture is going to be on tracking the costs from birth until death. Some of you might be saying, is she crazy? What does from birth until death mean? Remember, there are 3 product costs. We're going to track those today from birth till death. The 3 product costs are direct materials, direct labor, and factory overhead. Direct materials are born when the raw materials are dropped off at the manufacturing facility. So when I mean that we're going to track the cost from birth until death, I mean we're going to take each one of those 3 product costs and see how they make their way from the balance sheet where they're born, eventually crossing into cost of goods sold, which will mean they die. When a cost reaches the income statement, I refer to it as a dead cost. It has no more future value. I believe that the very best way to do this is by utilizing T accounts. Now, some of you may be a little bit upset with me because you won't see a whole lot of T accounts in your textbook for this chapter. But again, I have the wisdom of what's coming down the line. I also believe a picture is worth 1,000 words. And so if we can learn to create these costs and watch these cost flows by using these T accounts, I think this is going to make your life much better in the next several chapters coming up. So I'm going to invest the time right now to teach you about how costs make their way through the T accounts, knowing that the dividends on that will pay off in the end. When we get to the journal entries, you'll become pros because you'll be used to looking at T accounts. So this is the one slide I'm going to focus on for this part of the lecture. We're going to be looking at raw materials coming in, being used, and you're going to see that raw materials go one of 2 places. They either go into the production floor to be used on a product, or they get used in the general factory overall. In this chapter, we're going to assume that most of our raw materials are used on the production floor. And we're going to introduce this new account to you called work in process, or you'll hear me refer to it as WIP. Here's something I want you to definitely get down in your notes. All product costs go through WIP. Okay, I hope you heard that, and I hope you write it down. All product costs go through WIP. So when the direct materials are used in the factory to create the jobs, they go into the WIP account. When the direct labor or dirty touch hand labor is incurred in the factory assembly line, they're going to be charged to this WIP account. And when the factory overhead is utilized in the production of making those goods, in this chapter you're going to see 100% of the overhead charged out to WIP. In future chapters, overhead will become a little bit more difficult, but for this basic foundational building block of a chapter, we're going to assume, and your author's going to assume, that all the factory overheads accumulate in this dummy account called factory overhead and eventually are transferred out to the work in process. So once again, we're looking at balance sheet accounts right now because that's where the costs are first birthed. To explain this, I'm going to lecture as we go and use an exercise that I am 100% certain is similar to a test problem. So let me go over to that Excel spreadsheet right now. And let's take a look at exercise 14.7, and I believe we'll eventually get to 14.8. And here's what this is going to focus on: computing the cost of goods manufactured. Now again, you'll notice that your book doesn't use too many T accounts. I'm choosing to invest the time early in teaching you these T accounts so that you have a proper understanding by the time we get to job order costing and process costing of how the journal entries are going to come into play. In order to do that, I've given you this extra tab, this thing that I call a worksheet for 14-7. Now you may be looking at this worksheet going, whoa, that looks overwhelming. And it will be the first time that you do it. But after we practice and practice and practice, I believe if we invest the time now early in this first chapter, the upcoming next 2 chapters will be much easier. And so that's how I'm going to choose to teach this chapter. So they give us a list of accounts for Garcon. And again, you can see these on the previous tab. I did a quick snip before the lecture started to put them on this worksheet to prevent us from going back and forth between the tabs. So again, on this side, on the left-hand side of our problem, you see balance sheet accounts, and on the right-hand side of our problem, you see income statement accounts. And there's this dividing line here, and I'm going to make it yellow, in column O on my spreadsheet. Okay, so what are we going to do? We're going to accumulate the costs in these balance sheet accounts if they have future value, and then we'll watch them make their way from birth on the balance sheet eventually into their death on the income statement. How are we going to do that? We're going to learn how these T accounts work by doing an example. Remember, I'm going to make this a yellow highlighted item. Remember the statement I made in the lecture. All product costs go through WIP. So I'm going to go fill these beginning and ending account balances in, and our goal is to calculate the unknown items. In most of the cases, you'll see these in yellow. Okay, so raw materials is an asset account. Okay, that's a new account for us. It is an asset account, and all asset accounts are increased with debits and decreased with credit. You see me just do that on the screen. And factory overhead is what I refer to as a dummy account. If you've had me before, this is not the first time you've heard me refer to a dummy account. A dummy account is used to temporarily hold something and then disappears by the time the financial statements come around. If you've had me in a previous class, you may have heard me refer to income summary as a dummy account. It was used during the closing process, but it always went away by the time the financial statements were created. So what's going to happen with the overhead? All the actual overhead is going to be charged as a debit. And for purposes of this chapter, at the end, we'll flip that T account, we'll add all of the overhead up, and then we'll charge it all out to the WIP account. Okay, you'll watch me do that. So we've covered materials. We've kind of covered how we're going to do overhead. Labor is what I call a notes-only account. For our purposes in this chapter, direct labor is probably going to be given. So when I say notes only, we just might want to jot a note down if there's indirect labor or direct labor. This will get a little bit more complicated in future chapters. So again, back up, take a deep breath. What I want you to see right now on this page is a series of balance sheet accounts, which means the costs are building and building and building, and they're going to make their way from their birth. Everything's going to go through WIP. Remember what WIP stands for? Work in process. By the time the goods are done, you're going to see those costs transferred out of WIP and into finished goods. Finished goods, think of that account as a big warehouse. It's all the stuff that we've worked on and completed, and now it's hanging out in the warehouse until eventually it gets sold. Once the costs are sold, once the goods are sold, the cost is going to be transferred out of its final balance sheet account called finished goods and into cost of goods sold, where the cost will die. So again, our focus is on the balance sheet accounts that are accumulating the costs of this manufacturing environment. Eventually, when the goods are turned around and sold to our customers, we'll move the costs from the balance sheet, we'll cross that dividing line and go on to the income statement. So just give this a shot, see if you can follow along with me. I would strongly encourage you guys to use a T account approach on your homework. Even though it's not required, I believe that I'm in a good position to understand that investing the time now will reap huge benefits down the line. And I would encourage you to take to heart what I'm saying and start learning about these costs by using T accounts. Okay, here we go. Finished goods had a starting balance of $12,000, so I'm going to pop that in. WIP, which is a balance sheet account here, had a starting balance of $14,500. So I'm just going down and checking off these accounts as I use them. And raw materials had a starting balance. That means there was materials in the warehouse of $7,250 to start us off. Okay, I've covered the first three accounts. I think I'm going to move this up so I can keep everything on the same screen. Okay, so we've done the first three. The rental cost on the factory equipment. Okay, we learned in the earlier lecture today that that's an example of a factory overhead cost. So think about this dummy account as a list of accumulated costs on the debit side, and when we're done with this problem, we'll foot them all up, and in one shot we will apply them to the WIP account. So I'm going to create just this little itemized list. This is the rental cost of equipment. Okay, that is a factory account. We know it's related to the production of goods. And remember, all product costs are classified into one of three categories. Right now, that is in the factory overhead account, a total of $27,000. Okay, direct labor is $19,000. I called that just a note only. It's not necessarily an account. We're going to temporarily hold that $19,000 in labor there, and then eventually transfer it over to WIP. In fact, we can do that right now if you'd like. So let me go put that $19,000 over there. That would come from just closing out this little memo item. We would have nothing left here in this labor dummy account. All $19,000 is sitting in WIP. Okay, again, keep your eye on the goal. All product costs must go through WIP. We wrote that down in big letters as we were talking about the lecture. So what I'm missing now on my WIP account, I'm looking for direct materials and I'm looking for factory overhead. So I'm going to keep going down this itemized list of accounts that they're giving me, and I'm going to fill in the things as we come across them. All right, so I've done these first 5. Now I'm going to keep going. And again, I'm going to move this up so that we can see more of it. Finished goods inventory. This time they're giving us the ending balance. So that ending finished goods inventory is $17,650. The WIP ending balance, that means how much is on the shop floor, on the factory floor, in an uncompleted state. How do I know that? Remember, it's called WIP for a reason. The ending balance when we're done was $22,000. That came from our little list of costs here, right here. So we put that in. And now I'm just going to keep looking at this account. I'm going to keep filling the items in. And when we're done, we'll have a complete list of what happened to all the costs. So I'm going to keep going here. We had, let's see, we had the finished goods ending balance. We entered that in. We had the WIP balance. It's behind my list of accounts here. So now I think we're right here. The raw materials ending balance is $5,300. That means when we were done with this month's worth of activity or this period's worth of activity, we still had $5,300 of raw materials hanging around in that account. So let's continue going down our list. Factory utilities. Okay, anything that is related to the factory that is not direct materials or direct labor, by definition, is factory overhead. So I'm creating this itemized list in this dummy account. That was $9,000. Okay, general and administrative expenses. Remember that those were period costs. They were expensed immediately. So I'm going to go over here to the income statement and I'm going to drop in that $21,000 as just being normal G&A expenses. They gave me indirect labor. Okay, remember, indirect labor is a factory overhead cost. By definition, any indirect manufacturing costs becomes part of factory overhead. So I'm going to go ahead and put that indirect labor. An example that we talked about in the previous lecture today was the example of supervisory labor. Supervisors aren't on the assembly line. So by definition, their labor is what we call indirect, and that's accumulating in this big dummy account called factory overhead. Okay, let's keep going. Repairs on the factory equipment. You'll notice me enunciating my words. If it's related to the factory, it is a product cost. So repairs on the factory equipment would go in this big factory overhead account where we are accumulating the actual costs on the debit side. So I'm going to keep going down my list. In fact, maybe I'll move it up a little bit. That brings us to raw materials purchases, $33,000. Let's go ahead and put the raw materials account. We'll make it go up because when we buy materials and they arrive at our warehouse, they are placed in the raw materials account. Eventually, we will figure out how much of those materials were used in the production process. You'll see me do that shortly. And whatever materials we find out have been used to create the goods, we'll transfer the costs out of the materials and eventually into the WIP. You'll see me do that. Let's keep moving through these lists of accounts. We have selling expenses. Okay, remember those are period costs. They don't accumulate on the balance sheet. Instead, they are just immediately expensed. Okay, there we go. And then we have 3 remaining accounts. We have sales. Okay, well, we know what sales are. That is our major source of revenue. That was the case in Accounting 101 when we looked at merchandising entities. It's also the way that manufacturers make their revenue, by selling to usually middlemen. Could be end users, but usually middlemen. So we'll record that revenue in the sales account. As you know and as you remember, revenue accounts are increased by credits. And then these last 2 accounts aren't of much importance to us. They are balance sheet accounts, so if you want to use them someplace, we can use these other accounts that we've set up, cash and accounts receivable. They are very important accounts, don't get me wrong. They are very important accounts. But as far as following the manufacturing concept or concepts from birth till death, they're not really something that's of terrible concern to us right now. So just so you don't feel awkward leaving something off, I just added these 2 balance sheet accounts called cash and accounts receivable, and I went ahead and transferred the balances in there. Okay, take a deep breath because now we're going to do some calculating. I would encourage you guys to get your calculators out, or if you know how to use Excel, you can do the calculations with me here. Okay, let's finish up the problem by performing some calculations. Again, all product costs go through WIP. So we know that direct materials used need to go through WIP, direct labor needs to go through WIP, which we already have, and factory overhead needs to go through WIP. So let's start at the top and look at these materials. Look at the T account, which shows the activity. We started with $7,250 and we bought $33,000 worth of materials. That means that we had available to use, I'll call it, the sum of those 2. Add them up on your calculator, or if you're an Excel user, go ahead and add them up on the screen. That means we had available to use $40,250. Since 5,300 of those remained unused in the balance sheet, the direct materials used must be the difference between those 2 amounts. So over here in the yellow box, I'm going to calculate the difference between the 40,250 and the 5,300. If you want to do that on your calculator, let's check each other. You should have calculated 34,950. Okay, I'm going to transfer that out of the materials and into WIP. In Excel, I'm going to use a cell reference, which simply means you can type in the equal sign and then click on the number that you want to pick up. In my case, that is in cell C10, and I'll press enter. Okay, so look where we are now. We have materials used, we have direct labor, so what's missing in this critical WIP account now is factory overhead. How are we going to get that amount? We're going to add up, in this chapter anyways, it does become a little bit more complicated, but to begin with, we're going to add up anything charged to factory overhead. I'm going to call this a subtotal here. I will put it in red so it sticks out to you. and I will go ahead and sum up those 4 different factory overhead costs. I got $50,230. And so what we're going to do in that dummy account called factory overhead, which is used kind of like income summary, temporarily used to accumulate the numbers and then goes away, I'm going to transfer out that amount, 230, out of overhead and into WIP. In fact, if you want to use an equal sign to grab it rather than typing it, that's probably better. All right, here we come down to the grand finale. Probably the most important number that you're going to learn in this chapter is the cost of goods manufactured. It is the cost, exactly what the name implies, it is the cost of the goods that were manufactured during the period. How do we get it? We're going to take the beginning WIP, we're going to add in the 3 manufacturing costs that happened during the period of time that we're concerned about, and we're going to total these up. I'm going to call this a subtotal, again, for ease of understanding. So using your calculator or using Excel, go ahead and sum up from the top to the bottom. I came up with 108,680. That's all the cost that went through the factory during this given period of time. What we're after is what was the cost of goods manufactured. Well, here's what is still left incomplete or uncompleted. Sitting in that WIP account is 22,000 of unfinished jobs or unfinished goods. So the goods that we must have completed and that need to be transferred out because they are no longer under process or under construction is the difference between these 2 amounts. Again, I'm going to use cell references in Excel. If you guys were using a calculator, you would take 118,680 and subtract out the 22,000 that are still left hanging around unfinished in WIP. So using Excel, I'm going to take the difference between those 2 amounts that I just described. I'm going to press enter. Well, what happens to those goods that we complete that are no longer under construction? As you see by the arrow, they are transferred in to finished goods. So I'm going to take that amount out of work in process, put it in to finished goods, and now we're sitting here with this, again, I use the analogy of a warehouse account. Here's where all the goods that are finished and ready to be sold to customers are hanging out. So what I'm going to do now is I'm going to foot or subtotal this finished goods. So let me put ST here for subtotal. I'll make it red so it stands out. I'm going to do a calculation where I take that beginning finished good balance and add to that the cost of goods that came into the warehouse now completed. When I did that, I got 108,680. Well, not all of those goods remained at the end of the period. How do I know that? They gave us an ending balance of 17,650. So if this is how much was hanging around in finished goods during the year, and at the end of the period, this is how much was still left unsold, because remember what finished good means. They're goods that are completed and ready to be sold. There's still 17,650 hanging around in there. The difference between these two, let me go compute it, between the 108,680 and the 17,650, when I calculate the difference, we get cost of goods sold. What happens to those goods that are completed and sold? They go to their deathbed. So cost of goods sold is the amount that comes directly out of finished goods because it was sold to the customer. I'm going to go put a yellow box around it as well. 91,030. And what we've just done in this problem is we've tracked the costs from birth till death. Birth was the beginning of the direct materials, the direct labor, and the factory overhead. Looking at the materials account, it took a calculation to figure out the amount of direct materials used, and we transferred that over. The amount of direct labor was given in this problem. We transferred it over. And factory overhead line items or itemizations were given to us. For ease of understanding in this chapter, all we did is sum them up, transfer them over to the WIP account, and we're left with this, I call it magical work in process account. This is what the manufacturing process is all about. One of the most coveted numbers that we calculated today was this cost of goods manufactured. Okay, now we're going to be doing, as part of either this exercise or the next one, we're going to be doing a formal statement of cost of goods manufactured. Here's why I am taking your time, and investing in T accounts. Because the cost of goods manufactured is simply the sum of the manufacturing costs, materials, labor, and overhead, tweaked for the inventory balances. We added the beginning WIP, we took out the ending WIP, and that's how we calculated cost of goods manufactured. Again, a picture is worth 1,000 words. So if you're asked on an exam to do a formal cost of goods manufactured statement, wouldn't it be nice to be able to calculate the amount via a T account and then worry about the formalities of getting the statement to look right and so forth? And the same with cost of goods sold. Wouldn't it be wonderful if we could compute the answer before we started the statement? That's what these T accounts allow us to do. So shortly we'll be doing a formal cost of goods manufactured statement, and we'll be doing a formal cost of goods sold statement, but we have the answer in front of us because we've gone to the, I guess I'll call it hassle, of doing T accounts first. I cannot tell you how important it is to invest the time. If you learn this at the front end in this very first chapter, then doing journal entries and financial statements and a lot of other things to come will be much easier if you understand the mechanics. As a wrap up to this very important problem, use the lab time designated for this class lecture to create the formal financial statement. Once again, we went to the legwork of already computing the answer. So take a look at the formal financial statement on the right-hand side of the Excel screen, right here, and make sure that you can trace every single item back to the T account. Remember, the cost of goods manufactured is a summary of the WIP account. So as you'll notice here, there's 3 components. There is the direct materials, which came from the direct materials or the raw materials T account. There's the direct labor, which was given to us. We use a little memo account. And then there was the factory overhead, which was simply the sum of our itemized T account. Once we had those 3 components in, all we did is total up the manufacturing costs. This line item here is direct materials, direct labor, and factory overhead added together. And then a simple, what I call tweak of inventory balances to get us to our final number. We added in the beginning WIP, and we took out the ending whip, and just as we expected, our formal statement shows the exact same result that we came up with in the lecture part of the class. Finishing up this problem, look at the formal cost of goods sold statement. As we mentioned earlier in the lecture, the cost of goods sold statement is a summary of the finished goods accounts. So you can see that this finished good account is simply summarized on the financial statement. It was what we started with, plus the cost of goods manufactured, and by the way, that line item there came from the previous tab where we calculated that. We summed up those amounts. We took out the ending inventory because, of course, the ending inventory hasn't yet been sold. And we came up with the exact same answer as we had anticipated. Last thing I want you to do on this problem is use the hour or so of designated lab time to go and do the second set of data that was given to you in a problem. Get a fresh, clean T account, or better yet, get a fresh piece of notebook paper, create the T accounts for yourself, and see if you can come up with the proper answers. There's ungraded practice at the end of the Connect site. It's not graded, but it's there for you to have extra practice. And of course, if you have any questions, I expect you guys to email me, or you can go to an instructor lab tutorial, or you can meet with our embedded tutor, or of course, I always have office hours in the morning. But let's make sure we practice until we feel comfortable with the new concepts that we learned today. Professor Johnson, signing out.